Welcome to Zitron Squeeze, where we're pressure testing the AI boom from the balance sheet up. A lot of the AI story still gets told through stock charts, capex totals, and vibes. The harder question is whether there are enough real customers at real prices to justify what everybody is building. Start with the simplest claim in this set of reporting. A huge share of AI revenue attributed to Microsoft, Google, and Amazon appears to trace back to just two customers, OpenAI and Anthropic. The estimate floating around is at least 70%, based on analyses from UBS, Wells Fargo, Barclays, Bloomberg, and Deutsche Bank. If that estimate is even roughly right, then the headline number matters a lot less than the concentration behind it. Because concentrated revenue is fragile revenue, it can still be real, but it means the broader market may be much weaker than the top-line narrative suggests. That doesn't prove the AI build-out is irrational. Early infrastructure waves often start with a few giant buyers. The problem is that these two buyers are also heavily loss-making labs that depend on constant fundraising. So the bullish case isn't just that AI demand exists, it's that OpenAI and Anthropic can keep raising enormous sums and keep converting that money into cloud spending fast enough to support hyperscaler growth. That's a very different proposition from saying enterprise AI adoption is broad and self-sustaining. The next issue is the mismatch between compute supply and meaningful demand. The argument here is that the world is building something like $360 billion to $435 billion of annual compute capacity off projected GPU sales, while demand outside hyperscalers, plus those two labs, is still only in the low single-digit billions. If that's true, then scarcity may be getting misread. A shortage can mean demand is deep and durable, but it can also mean supply is bottlenecked around a narrow set of buyers. Those are not the same thing. Microsoft is a useful example. One estimate puts its AI revenue at $34.43 billion, but after backing out OpenAI, only about $10.33 billion is left for everything else: model APIs, GPU rentals, Copilot, all of it. On its own, $10 billion isn't trivial. The question is whether it remotely justifies capex on the scale Microsoft is now running, including $41 billion in a single quarter and more than $261 billion since 2022. The stronger version of the skeptical argument is not that AI revenue is fake, it's that relative to the infrastructure bill, it still looks tiny. The weaker version would be claiming this settles the long-term case. It doesn't. Infrastructure spending usually arrives before utilization. But if planned capacity really implies over $1 trillion in annual compute spending while best-case demand is closer to $110 billion, then timing stops being a footnote and starts looking like the whole story. This also helps explain why the debate gets so slippery. After the pandemic, growth slowed sharply at Google and Amazon. Then ChatGPT arrived, and suddenly there was a fresh narrative investors could attach to renewed spending. Narratives matter because markets don't wait for clean accounting. If investors believe AI capex today buys durable platform control tomorrow, then current revenue gaps can be tolerated for a long time. But that's also where spin creeps in. Rising total revenue and rising stock prices do not by themselves prove AI revenue covers AI spending. The Microsoft figures in this topic make that point sharply. In FY 2025, estimated AI revenue was about $14.86 billion, including OpenAI, against $64.6 billion in capex. Excluding OpenAI, the number drops to roughly $5.7 billion, around 2% of total revenue. That doesn't mean Microsoft shouldn't invest. It does mean the phrase AI is already paying off needs to be unpacked. Paying off for whom, on what time horizon, and against which costs? The social incentives matter too. Access journalism, analyst optimism, and executive credibility all reward staying inside the boom narrative. That doesn't make every bullish claim dishonest, but it does mean listeners should separate evidence from status signals, like smart people wouldn't spend this much without returns. The financing story around Nvidia is where things get especially murky. A lot of coverage treated Nvidia's talks with Apollo, BlackRock, Blackstone, Brookfield, Goldman Sachs, and KKR like a $500 billion infrastructure deal, but the actual announcement was a memorandum of understanding about possible financing platforms, not a funded $500 billion commitment. That's an important distinction. An MOU can be strategically meaningful, but it is not booked demand and it is not proof that end customers exist at profitable utilization levels. Then there's the proposed residual value support, with Nvidia offering up to 25% backing on certain projects. The concern is straightforward. If financiers can lend against GPU projects, partly because the GPU maker itself softens the downside, that can stimulate more GPU purchases whether or not organic demand is there yet. That doesn't automatically make it improper. Vendor financing exists in plenty of industries, but it does blur the line between independent customer demand and demand supported by the seller's own balance sheet and influence. Same with the OpenAI headline about a $100 billion Nvidia investment. Later it sounded much more like an invitation to invest up to that amount than an actual commitment. Again, the recurring issue is theoretical financing being narrated like hard demand. The final question is second-order risk. Nvidia's growth forecasts are enormous, with revenue expected to keep climbing sharply over the next several fiscal years, and nearly all of it tied to data center. For those forecasts to hold, hyperscalers probably have to keep accelerating GPU purchases while OpenAI and Anthropic keep spending at extraordinary rates. Meanwhile, those labs reportedly face more than $1.1 trillion in commitments through 2030, and the hyperscalers themselves may pour another $1.5 trillion into infrastructure by the end of 2027. So the dependency chain matters. If the labs wobble in fundraising or usage growth disappoints, it's not just a problem for the labs, it hits cloud revenue growth, then infrastructure utilization, then the suppliers whose own valuations assume the build-out keeps compounding. The apocalyptic framing may be overstated. Big tech companies have diversified businesses, real cash flow, and room to absorb mistakes that smaller providers do not. But the core warning is well supported. If most current AI demand is concentrated, subsidized, and finance dependent, then the system is less robust than the public story implies. The open question isn't whether AI is useful, it's whether the current scale of investment is being pulled by durable customer economics or pushed forward by capital markets that still want the story to be true. That's the squeeze on this one. Plenty of spending, some real revenue, and a much harder debate about how broad and durable the demand really is. Thanks for listening to Zitron Squeeze. This episode was generated by Podkey. Create your own at podkey.fm.